On the podcast with us today is Caleb Bryant. Caleb, welcome back to the podcast.
Hey, Dan, how are you doing?
I'm doing pretty well. I know we had you on a few episodes ago, actually probably about 10 episodes ago, and where you went through the Warrior Apartments, which is the 75-unit property out of San Antonio, Texas. So for those of you who are listening to this episode and you want to catch another one that Caleb did earlier this year, this is his second acquisition that we're going to be going through today. But Caleb, for those that don't know you, haven't listened to that first episode, give them a little bit about you and your background and where your current focus is right now in the multifamily space.
Yeah, absolutely. I'm Caleb Bryant. I'm originally from Blacksburg area, Virginia, and I got interested in multifamily specifically, or real estate because of my parents and their network. But then I saw their network investing in transactional type real estate. So I went the direction of multifamily because of the cash flow, the economies of scale, and all the advantages there. It's been about two and a half years now since I've really been investing in multifamily. About 5 years since I've been studying it though.
So you've definitely been studying it for quite some time now and have now started to get deep into it and start closing some of these deals. So that's really exciting. And like we said earlier, this is the second one. This one is actually called Summer Rise Apartments. It's located in Center Point, Alabama. It's a 1970 vintage and it has 96 units on it. You guys closed on this one in late January of this year, January 31st, 2019. So talk to us a little bit about how you sourced this deal to get us started.
This particular deal came through a broker relationship, and we had been talking with this broker for a while and telling him, constantly giving him feedback about what he was sending to us, because we do get a decent amount of deals coming through that we get to look at. And the week before we got this deal, we looked at this massive deal. It was like 1,800 unit portfolio. And we did it more just to experience the walkthrough, knowing that $90 million plus is probably a tough one to tackle for us. But
1,800 units, yeah, that's pretty big.
Yes, but the connection of actually going out to the property, walking with the broker, helped us with. I guess it rang his mind because he's like, "Oh yeah, I know this owner and they were trying to sell this property a while ago and it never sold. You want to talk to him?" So we did, and here we are.
I mean, so this 96 unit one was inside of that 1,800 portfolio?
No, it wasn't.
Is it a different portfolio?
This was a part of a portfolio. And yeah, we mentioned, I was talking with Dan a little bit before we started recording. So the reason we got this at such a good deal was because this property was a part of a portfolio. Like you said, I believe it was 4 properties, and this portfolio was for sale a few years ago. I believe 2016 or 15, and a buyer came along, was going to buy all 4, but there was a title issue on the 96 unit that we picked up at the time. So they got cold feet with that property, but bought the other 3. And that ended up being a big problem for the seller because they lost their economies of scale. They didn't have the same management advantages that they had before, and this was their only 96 units in the Birmingham area, at least that we're aware of. So it kind of created a problem for that owner, and they were a big owner. They own their parent company owns around 50,000 units. So they know what they're doing. It just I guess the size, the smaller size doesn't fit their model.
Yeah. So on this particular one, how much did you? Well, let's first back up just a little bit. So you found this through the broker that was originally in this portfolio that had been split off because of some title issues. Since then, they kind of got it all cleaned up, I'm assuming, once you guys started, taking the offers on this thing or putting the offers on it. And when you found it, was it listed with that broker, or was it at that point off market?
It was off market. And I don't know if he had tried. I don't know if this broker had tried to like list it before or not. But one way or another, it ended up with us because he knew it kind of fit what we were looking for, and he knew the buyer was probably trying to get rid of it based on they had been through maybe 3 managers in that time frame, just trying to find something that worked. It was they just weren't doing well with this particular property.
How much did you acquire it for?
We picked it up for $2.8 million, or that's what was on the contract. We ended up getting a little bit of insurance money back too.
Well, we definitely want to dive into that as we go forward with this too.
Yeah.
I'm sure that'll come up. So was there, since this was off market, was it off market like just to you, or were there other people kind of competing on this one too?
While I don't know if we were competing with anyone, I would assume that we weren't based on where we came out, simply because they wanted 3.5. We know they paid 3.25 for the property, and we offered 2.4, and they countered with us. So we think we might have been the only ones in play.
Wow. Yeah. And how many rounds of offers going back and forth did you go through?
I believe it was just 2. They came in a little lower, trying to basically get what they paid for it, and we're like, look, 2.8, or we're gonna have to go.
So the negotiations went 2 point. They basically were trying to get 3.5, and you came in and said, "We'll give you 2.4." And some people would look at that though, Caleb, and go, "I don't even know if I want to offer it because I don't want to tick off the seller or something, or make them feel bad."
Yeah, I don't know. Sometimes I feel that way. Sometimes I'm like, well, I know they want it gone, so it doesn't hurt to offer. I'm not trying to hurt people's feelings, but I'm trying to get a deal.
Well, I mean, that's why it's important to understand the story of the seller, because if you can now get into the head of the seller, now you kind of know how to negotiate where their pain points are. And for you knew that going into it. You knew they have a portfolio of 50,000 units already. This is a small 96 unit one. They don't want this on their books anymore. They want to get it off. They tried to sell it in a portfolio, had some title issues, couldn't get it to sell. Now they're ready to offload. Yeah,
so it's just a line item to them, or that's how we saw it, and we acted accordingly.
Yeah. So you offered 2.4. They came back and said, we'll offer to you back for 3.25 or whatever it was. And then you came back and said, 2.8, take it or leave it, or we walk.
Yeah, that pretty much just like that.
Well, good. All right. So we're at 2.8 million. And what are some things that maybe came up? Well, I want to get into the due diligence piece of it, but first I want to ask you about any type of earnest money that you had to put up, because obviously this is off market. You're probably the only one dealing with it. So I'm sure you had to put some earnest money up. So how much earnest money did you have to put up, and at what point did it go hard?
25,000 in earnest money, and it didn't go hard until we were past the due diligence phase. Past the due diligence phase, but before the financing phase.
Okay. Had a financing contingency in there.
Yeah.
Okay. And so at what point did you tour this property?
The entire thing in due diligence, but we went through several units before we had it on our contract even.
Okay.
So I don't know, maybe 15, 20 units before, probably closer to 15 units before we even had it under contract, and then did our more thorough walkthrough during due diligence. Because we kind of talked with the owners and worked through some of our process before we even had it under contract.
And when you were going through that walkthrough, is there anything kind of, this is, and I'm talking about, before you got it under contract, was there anything that you kind of looked at and said, oh, that might be an issue. That might be an issue that you're going to have to maybe dive in a little bit deeper on this one?
Nothing major, no, because the property we did before, it was a heavier lift. So this one was like, oh man, that's going to be easy. Okay, that's going to be easy. What we did look for is just we wanted to make sure like plumbing was good. So if we saw any signs of leaking or anything like that, that would have caught red flags. But we didn't see anything in those units, so we pushed it back to the due diligence phase.
Okay. All right. And now we're in kind of this due diligence process and this due diligence phase. What are some things that came up during the due diligence?
Nothing major. The one thing that we did come across is, and I say nothing major during the normal due diligence at least, when going through leases, we noticed that there weren't very many deposits. There were a lot of fees. And so there was essentially money missing in certain areas. So we had to kind of work with the manager. She knows everybody basically by on a first name basis. And, oh yeah, unit, she knows it by the unit. She's like, yeah, he pays 3 days late every time. And he's real nice though. Like she knew it on that level. So she knew where we could find evidence of these fees. And then basically we went back and said, hey, we know you're taking fees instead of deposits because maybe their credit isn't where we'd like it to be to feel safe, but we're going to need those fees because if there's a problem with the unit, that's kind of what we were banking on because that's what deposits are typically used for. So we we negotiated those back.
And that was a credit at closing?
Yes.
Okay. So you got a credit at closing for those. What kind of money did that equate to?
I feel bad, but I do not remember. It wasn't super significant. The biggest fee that they had was $300. And then about at least a third to maybe half of them had deposits. So
maybe 5 to 10 grand, somewhere around in there.
Somewhere in there.
Yeah.
Nothing too major, but it's still could come back to be beneficial.
So as far as any like a deferred maintenance or anything like that, was there a lot of that on this property or had it been pretty well maintained?
So you could tell that for a while it had been maintained pretty well. And then probably shortly before they were looking to sell back a few years ago, it started declining a little bit. So while there was nothing major, it's a little bit more tired now. The things that were heartening or positives were the roofs still need to be replaced for a while. Those are pretty solid. And then it's a brick, mostly brick exterior, and there was no signs of any shifting or foundational issues or anything like that. So those were huge positives, and we figured most everything else we could work with.
Yeah. Well, that's actually pretty good. So speaking of the property management, what kind of property management did they have on here? Was it how many people were on site, and was there a third party, or was it just the on-site staff?
So it was a third party, and so there was the manager. They had a leasing agent at one time, but when we picked the property up, there was no dedicated leasing agent. They had a lady for basically like clean outs, and then a maintenance guy. The problem is the maintenance wasn't really doing anything. They'd get requests, but he wasn't spending his time actually repairing anything. So we had to we had to adjust accordingly. And now we're using a very similar. We replaced him, but we actually kept the manager because she was relatively newer, but she was helping the property turn the direction we wanted to see. So right now she's working for us and she's doing a great job. And we hope she'll continue to do so. But she had that intimate knowledge of everybody. She knew what she wanted to do. It's almost like she was being controlled and not allowed to do certain things, which was probably holding her back from her potential. So now that she has a little bit more control or more resources, she's feeling better about her job and doing a great job.
So did you switch out the third-party management company, or are you now self-managing?
So we hired her for us, but not her company.
Okay. So you're still paying for her from the salary component side of things, but she's pretty much your property management company, if you will. You're on site. So you're basically self-managing the manager, if you will.
Yes, that's absolutely correct.
Okay. What did the lender think of that?
They're fine with that because we do it on all our properties.
Okay. So they kind of had that as a, you already have been doing that. You're doing well with it. We'll allow you to keep doing it.
Yeah. So the guys I teamed up with have been doing it since at least 2015, maybe a little bit before then, but they started using that, doing it that way because they were having problems with managers, whether it be stealing or just not taking the care of the property that they wanted. So they started doing it all in-house, hiring people to manage their properties. And then when I joined in, I think the first people besides like Ken McElroy's book and Dave Lindahl books that I really started following was Jake and Gino, and they have their own in-house management too. So I was like, oh, sweet, perfect, let's do that.
That's cool. Now, what kind of software do you use on that property for the property management?
Appfolio.
Appfolio. Okay. And are all of your assets using that?
Yes.
Okay. We need to get a contact from them and have them sponsor the show.
Yeah. Do you have a lot of people using Appfolio?
We actually do. We have quite a few. So usually it's Appfolio, Rent Manager, Rent Cafe, the Yardi Matrix software, stuff like that. But Appfolio is definitely a really common one. Maybe if we say their name a few more times, they'll
be like, this is worth paying for.
They give me a call and they can start sponsoring the show, right?
Perfect.
So let's talk about the financing on this one. So it's a $2.8 million acquisition. And what kind of financing did you guys end up getting on it?
So we typically use this with every deal, but we went with a private money lending source that my team has had great contact with over the years. They've closed a number of deals with them. And we loaned 2.5 on the $2.8 million purchase price. So our loan was $2.5 million. The terms are never super great on those, but the cool thing he allows us to do is roll some of the interest into the loan. So it's essentially a no payment loan for a short amount of time, which helps us with any cash flow issues, things of that nature.
What was the occupancy like on this one?
This one was 92% occupied, but it wasn't the right kind of 92% occupied, if you know what I mean. So
was it physical 92, but the economic was not?
Yeah, the economic was a little bit lower. And not only that, is some of the tenants maybe that even were paying weren't necessarily good apples, so to speak. So we had to get rid of when I say get rid of, we had to offer cash for keys for a few people, and it worked. And we replaced about 15 to 20 tenants right at the beginning. Wow. Which has been good. So it didn't really the occupancy didn't drop drastically, but there was a major shift in the makeup of the occupancy.
So for somebody who's listening, that might be they're just getting started in multifamily, and they're hearing you say cash for keys. Can you explain that to them so they kind of understand what that means, and maybe even tell them maybe what you guys ended up having to pay for that?
So we always start low, see if you can offer them $100 and they'll leave, and some do. So we'll start there, and the theory behind it is a lot of these people, either they haven't been paying, or they have this big account that they're behind on, or you're going to have to evict them anyway. So you're trying to avoid that process if possible, avoid any more missed rent, just kind of start fresh. So you offer them cash for keys, and sometimes you got to offer them a little more than $100. But usually if it's really a problem tenant, getting them out is better for the property, and you might as well spend $500 to help them go get a place somewhere else than keep them on your property.
No, I think it's a great strategy, especially in, I think that you're even able to do that in some of the rent control states too. That's kind of an extra way to kind of incentivize some of the rent controlled areas to get them out too, right?
I don't know, because I don't invest in rent control states.
Neither do I. So we're all hypothetically coming up with these solutions, and neither one of us invest in those kind of states. But
Good
I
for
would
them.
think it'd be a great opportunity for a rent control state to give them cash for keys.
Yeah, if you can do that, then go for it. Because
So what was the decision to go with the private lender in the beginning of this one instead of trying to be like a Fannie or Freddie on this one? It seems like it'd be a perfect, like, Freddie small balance.
we're just able to close so much quicker, and we're able to get in for so much less money.
Mm-hmm.
So Fannie and Freddie, they're going to want us to do some things, and we're going to get around to like as far as repairs that needed to be done over time. We need to replace a few of the windows. We need to do some of the soffit on certain buildings and some guttering. But we don't want to have to come in with, say, I can't think of what 30% of 3 million is right now. So say 600,000 ish. We wanted to be able to get in for around 300. So the private money helps us get in with less money, and we're also able to move very quickly. So we only had this under contract for 30 days.
So you actually got it under contract and closed and did due diligence and everything in 30 days.
Yeah, but we cheated a little bit. We were on the property before we had it under contract. So
kind of skirted that just a little bit there, but still, I mean, it gave you that early access, which is always nice.
Yeah.
So what's the plan in the future to get out of the private loan?
So we're already doing that, and it should close in the next week. Hopefully by the time this airs, we've already picked up the next property, but we're working on the refinance right now. And this is also interesting. So we're obviously not putting it right into Fannie Freddie because they have to have seasoning. So we're putting it into a whole different structure type private loan that we didn't have access to before. And it's going to work for us really well because it's just an interest-only loan. It's a 5-year term with a 5-year extension opportunity, but the prepayment penalty is only for 2 years. So our thought is in 2 years, this thing is going to be in great condition. We're going to have it occupied well, and it will have been occupied for a while, and we'll have a pretty good history of cash flow. At that point, we'll shift it without any penalties over to Fannie or Freddie financing, agency debt, and it'll cash flow even better so long as the market is in a position where that makes sense.
So on the private loan, what kind of interest rate did you get on that? I know you said it wasn't the best terms, but because it's obviously a very short-term one, but I'm sure you've done business with them before. And I think you had mentioned them on the last deal too, I think. But what kind of rate are you guys getting on that?
So the loan is 15%.
Okay.
And we're able to roll, so the first 3 months worth of payments, we're able to roll that right into the loan. So we didn't have a payment. Now, the term itself is like, I believe it's 1 year with an extension. We always have an extension. We want a couple years worth, but we never actually want to use that. That's just there for protection. Our goal is always to get out in 6 months. But on this particular one, we're going to be out fully in 3 months or very like a week after 3 months at most. Which is good for us because we never actually have to dig into the wallet and pay that massive 15% interest payment. But we aren't doing any distributions during this 6 month period, or in this case 3 months, simply to be setting aside cash for those payments if need be.
So the 15% for that first year, is there a penalty? Like a yield maintenance or anything like that on that one? Or is it just, whenever you get out, you get out?
When we get out, we get out. He's making his money.
Okay. All right. And so when you got it into this other loan, it sounds like it's a bridge loan, but it seems like a pretty long-term bridge loan for a 5-year IO with 2 years yield and then, a 10-year term, if you will, or I guess you have an additional 5-year option to extend. So what kind of loan is it? Is it a bridge, or is it just kind of like an alternative, loan? Or
it's just creative finance, man. I don't know.
Okay.
I don't know if it has a technical name. It's private money, and the way they do it is they base it off either the LIBOR or for your initial rate off the LIBOR or Wall Street, and they'll do like two over prime. But it's fixed, so it doesn't adjust. That's just how they gauge the intro rate. So for us, it's going to be 7.5%. Our payments, we're looking at $18,750 for our payment, which is actually better than we projected our payment to be, but we were also projecting like an amortized 30-year. So it's interest only, but our cash flow will actually be up for the first 2 years of our projections, which is pretty cool.
Now, is this one non-recourse as well?
It is non-recourse, yeah. So the first one is not non-recourse. It is a recourse loan. And then this second one that we're going into is non-recourse.
And what kind of proceeds do they give you?
What kind of proceeds?
Yeah. What's the LTV on it?
Oh, LTV. 3 million on 4.85, somewhere in there. What is that LTV?
That's pretty stout to be able to. You guys basically got a really good deal on this thing because you have it, appraised at over $4 million and only 3 months into it. You better refi out all of that. Plus, are you pulling capital out too?
Not very much, but a wee little bit.
Yeah.
On this one, we didn't want to push it. We're like, let's make it cash flow as good as possible because we can always get if the market makes sense, we could always get a little bit extra out when we move to the other loan type. And it's going to be a better interest rate when we do that as well, unless something goes ridiculously crazy in the market. So we're expecting, or we're not worried about taking all that money up front. We're more worried about the cash flow and the long term.
So how did you find this lender?
Constant networking. So sometimes they reach out to me. This one, Anthony actually found. So I can't answer that question directly, but we're constantly reaching out to lenders, so I do a lot of Facebook marketing and I get a lot of lenders to reach out to me. And because Anthony's more the finance guy, I'll do like a screening call. If they're worth anything, then I'll forward them over to Anthony and we'll see if we can work with them. But this one, I'm not exactly sure how he found it, but those are the typical techniques.
So what's the plan for the hold on this one, the hold period?
At least 10 years. So we didn't do like a typical, I guess, syndication where we have to sell. I did a thing where we could sell, and I just projected it at 4.6 million sell price. And I forget what the cap rate on that, but it's pretty low. It's pretty high. I think the cap rate is about 1.5 above what the market is right now. But I didn't put a lot of thought into the exit that way because our exit really, we have the property still, but we think of the exit as this refinance, get all the money out. Now now it's all cash flow and it's an infinite return because everybody has their money back. So we want to hold them, build as many of those as we can. And in the future, because it's a joint venture structure, we can all decide to sell it if it makes sense in the market, or if it doesn't, we just keep holding it and keep cash flowing.
So when you're doing projections on a property like that, where you're, going to be into it for at least 10 years, maybe even more, depending on, how the property goes and performs and how you guys decide to do things, how do you project things like the IRR and cash on cash and like equity multiples and stuff like that? Obviously cash on cash you could do because of the amount of equity you have into it. But, you talk about IRR, I think they kind of get a little bit of a hairy calculation if you don't really know what your exit strategy is going to be.
Oh, yeah. So I don't even want to pretend like I have any idea what the IRR looks like, but I'll just tell you how I pitched it to our investor partner. So we did a joint venture on this, and I talked to a few people that were interested in being involved in a multifamily deal. And we got a great partner who lives in Hoover, which is south side of town, and this property is northeast side of town in Birmingham. And so she's on the property every week, just like us. And the way I pitched it to her is how quickly your capital is being returned. So the cash on cash isn't super amazing. It's like 7.43% based on her money put in. But she has her money back, so she can stack that. And that's kind of the way I pitched it. While she is getting a little bit of where we're taking out more than we put in, she's getting a little chunk of money from that as well. The cash on cash return isn't necessarily that great. It's just the ability to be able to reinvest the money quickly. So I just tell them what I'm doing. I tell them exactly what I'm doing. I'm like, I've already done it with the 75. I'm looking to do it again with the 96. I'm inviting you to come do it with me.
Yeah. So you kind of tell them, hey, this is what we've done in the past. This is what we want to do with this project. Are you in or are you out?
Yeah. I talked to them about the expectation of like, this is most likely a long-term hold. If it makes sense to sell, we can all come together and agree, excuse me. But the main business plan is a long-term hold.
And so speaking of investors, so we talked about some of the financing piece of it. The amount that you actually raised on this one to get into the 2.8 was how much?
So rate brought in from someone else was $250,000. And then total money to close the deal was around 390,000. And I'd say around 90,000 of that was just due diligence type items. No, some of that was also a reservation or a reserve fund, but
say $90,000 on a 96 units, pretty expensive on due diligence.
Yeah. That was operating account plus due diligence, and we did
cool.
Study, the survey, the appraisal, all that, and we wanted to double check that title too and make sure everything was squared away there. Which you're always checking title anyway, but we did a little extra just to make sure that we were all clear there.
So you mentioned earlier on in the show about the 2.8 million was the contract price, if you will, and you got a little bit better than that due to some insurance proceeds or something like that. What was that involved with?
Well, so going into the property, we knew there were 2 units that were burned. There were burn units. There was a fire, something to do with a gentleman cooking. So we knew there were 2 units that were down. They're down pretty much to the studs. And we thought, well, that just gives us a blank slate. Let's just take his insurance proceeds for that and be able to get those up to market, full market rent pretty quickly. So we saw it as an advantage. But then we had basically just put the contract on, actually, and we got a phone call, and there was another fire. And actually, this one affected 4 units. And again, to the studs. Luckily, the roof wasn't damaged.
So this all happened after you got it under contract?
The 4 units that we knew going in that there were 2, but there's a total of 6.
Wow.
So that happened. It was either the day or 2 days after Christmas, I believe. And so that could have been a problem. That could have knocked us out of the deal, but we just negotiated, hey, when we're going to get your insurance settlement. We wrote that into the contract, and we basically got it for 2.6 instead.
But obviously that 200 is going to go back into trying to get those 6 units back online.
That's correct. But I don't want to say it's a benefit, but the one good thing from that is we can go and do exactly what we want, and we can get full market rent on those units immediately instead of having a lease take up maybe 6 months, and then we can go in and change rents. We can do it quicker. And they were all 3-bedroom units, the 4 in the fire. So it was our highest grossing units anyway. So that it was kind of the best of the worst.
Yeah, that's true. Well, so I have 3 last questions. So, the final question. So the first of the 3 is going to be about any issues that we haven't talked about yet. Have you thought of is there any other issues that came up during the entire process of getting this deal closed that you can think of that we haven't covered yet?
I mean, the fire was the biggest one. What we looked for was anything to do with electrical, plumbing, or if there was a major trend in like maintenance requests. Mm-hmm. We didn't see anything too scary there. One value add I didn't mention earlier was the water study we did. We found a way we can save significant amounts of money by there were basic rubs on the complex already, but Jefferson County water and sewer is quite expensive, so it wasn't covering even close to the water bill. So we're able to, because everyone else in the area is billing back the tenants, or rather they're metering the tenants, we're able to do that as well. It was already available. I don't know why the owner didn't take advantage of passing that expense on, but we're able to save over $12,000 a year just from that.
So where did you actually sub-meter it, or did you just start to have them bill back?
No, it's set up like it's separately metered already.
Oh.
They just weren't they were just doing, maybe, I don't know, maybe they put those systems in, but they were only getting about
50,000 units. I bet it's probably easy to forget about 96.
Yeah. I guess that's what happened, but they were billing back like 40, depending on the unit, 40 to $50, and the bills were closer to 160, 170, and we don't want to pay that extra 120 difference or whatever it is.
So what did you find easiest throughout this entire process that maybe you thought was a little bit harder going into it, that you thought it was going to be a little bit harder going into it?
So it almost felt easier doing more units because the last one was 75 units. But this was a newer property, and it was brick. The whole process seemed smoother with the exception of the fire. So I guess maybe at the beginning I was a little intimidated, thinking, oh, this is a big property. This is like a $5 million property. But it ended up being a much smoother process than I expected it to be.
So the last question here is kind of the opposite of that is, what did you expect to be much harder that, or what did you find that was much harder that you had thought originally that might be a little bit easier?
Selling people on the deal, even though we got this thing at 2.8 million and it's a $4.85 million property. And sometimes it's hard to sell investors on that because they're like, well, no, it's not. You're paying 2.8 for it. That's not.
It's worth what somebody's going to pay for it.
Yeah. So it took them. It might have taken a few more calls than I would have liked to get it done. But overall, that was well worth it. It only took 14 days to get it all funded and ready to go. So.
That's cool. Well, I want to thank you again for coming on to this episode and kind of sharing some more about the Sunrise Apartments there in Center Point, Alabama. I know you're going to continue to close more deals, so I know we'll see you back here, hopefully in a few weeks or at least the few months. Unless you have one under contract now. Do you have one now?
Not yet. Very soon.
Not yet. We won't push the luck a little bit there, but. Feel free to reach out when you have your next one. Love to have you back. Love having having you on, hearing your unique financing strategies and the different stories you have about how you're putting these things together. How can the listeners reach out to you, Caleb, if they have some more questions or want to reach out to you or want to kind of follow you a little bit further?
Yes. So first and foremost, you can hit me up on Instagram. That's at Relentless Investor. I have a brand new website done by Margaret Cogswell, and it is www.relentlesscapitalgroup.com. But if you really want to reach out to me, just give me a call or shoot me a text at 615-752-8520. Happy to talk.
That was breaking up just a little bit when you gave your phone number out. So repeat that one more time in case somebody didn't catch it.
Perfect. Yes. 615-752-8520.
Great. Well, thank you again, Caleb, and looking forward to having you on a future episode. But I hope you have a good rest of your day today.
Appreciate it, Dan. Thank you so much.